Hello, welcome to today's video. The topic of today's discussion is leverage. So what is leverage? Leverage in common terms means to lift up something. If we are taking the help to open something, that process is called as leverage. But in a business point of view, it refers to, one can say, it is a tool that is used by a business to grow their assets, to purchase their inventories, or to purchase equipment. So leverage is a form of debt. Leverage refers to a form of debt. It is a form of debt which a company use to finance its assets. So one can say leverage represents debt. A firm with high debt is termed as high leverage firms. A firm having debt in their capital structure, high amount of debt, is termed as high leverage firm, whereas a firm without any debt is termed as unlevered firm. So leverage represents the long-term borrowings, the borrowings funds on which the firm has to pay a fixed amount of money in the form of interest as well as principal amount for a particular period at a particular rate. So one can say leverage represent the form of debt. So leverage refers to the ability of a firm in employing long-term funds having a fixed cost, that is in the form of interest, to enhance returns. The main purpose is to increase the returns to the shareholders, to the equity holders. So leverage act as a one can say component which help in increasing the returns of the shareholders. Okay, so if in financial management, finance point of view, we can say leverage is a term that it is a relationship between, leverage shows the relationship between two interrelated variables. Two interrelated variables means the change in one variable. If we change one variable, it represents the change in another variable. So in the context of financial management, the term leverage means sensitiveness of one financial variable. How sensitive one financial variable to change in another. Okay, so leverage is percentage change in dependent variable. The variable which is dependent on the another variable is termed as dependent variable, divided by percentage change in independent variable, the variable which we changed. So the impact of change in one variable, how the change in one variable impact the change in another variable. So here we see the impact on profits. How we change the sales, that will impact the profits of the business. How we change our EBIT, that is earning before interest and tax, and it will impact the earning per shares of the shareholders. So this is termed as leverage, to gear up, to lift something. Okay, so the functional relationship says that it is very important to understand this function, that is sales minus variable cost is equal to contribution. If we deduct variable cost from our sales revenue means the amount we get, that is selling price, the amount, the product we sell at our price, that is sales revenue. Whatever amount we get after selling our product is sales revenue, minus variable cost. If we minus fixed cost from our contribution, we will get earning before interest and tax. And if we minus interest, that is interest paid, this interest is interest paid to debenture holders. Okay, then we will come with earning before tax, and if we deduct tax out of it, we will get earning per share. This earning is distributed to their respective shareholders, equity shareholders, to the owners. So operating cost is of two types. There is a cost termed as operating cost, fixed cost and variable cost. Fixed cost is the cost which remains fixed. It doesn't change with the change in sales. That is, it doesn't have any effect. It is not considered with your output, your production, how many units you are producing, whether you are producing zero number of units or producing 100 number of units, whether you are running in profit or in losses, you have to this fixed cost. It remains fixed. Okay, for example, you can say your depreciation cost is of the fixed cost. It is the assets you are using, whether you are using that assets or not, you have to bear this depreciation cost. Next is variable cost. Variable cost is the cost which varies with your sales, with your output, with your production. For example, commission, or you can say raw material used. The number of it is varies. If you are using high raw material, more large quantity of raw material, then your cost will be large. If you are using less raw material, your